Good afternoon and welcome to Pincus Co Live. Today we are speaking with three individuals who have expertise in the Bushwick and Ridgewood markets of Brooklyn and Queens. Laurent Wendum, he's the co-founder and managing partner of Jane Capital, which owns about 15 properties in the area. DJ Johnston is a partner, senior managing director at the brokerage B6 Real Estate Advisors, where he oversees investment sales in Bushwick, Bed-Stuy, Crown Heights, and Prospect Lefferts Gardens. And Joseph Rosenfeld, who's a member of the Schuckman Realty investment sales team, where he focuses on Central and Northeast Brooklyn. I'm Adam Pincus, founder of Pincus Co Media, and we publish newsletters and data. This episode is sponsored by G-Parency. It's a provider of technology solutions designed to empower commercial property owners and reduce the reliance on certain high-cost service providers. This is our 11th live broadcast. Prior episodes are on our YouTube channel and via podcast. Before we start, I want to give a very brief intro on Bushwick from some data that we had. We looked at stats on Bushwick, and it turns out it's got far fewer elevator buildings than other markets like Williamsburg. That's well known to a lot of people in the business, but I didn't know that. We count about 340 elevator buildings in Williamsburg with about 18,000 units. And in contrast, Bushwick's got about a third of that, with about 125 units, buildings with about 6,700 units. However, Bushwick's got about 2,400 walk-up buildings with about 18,000 residential units. We're mostly looking at 4 units and up. So some of the stats are different depending on which way you cut it. So the bulk of the transactions that we see are actually in the tax-protected 2A, 2B classes. So those are some of the numbers that we had. So I want to start with DJ and give us the overview. And thanks for joining.
No, my pleasure. Thank you, Adam. I love that the four of us are talking about a neighborhood that we are not cool enough to live in, which is Bushwick.
Hey, wait a second.
I've been working in Bushwick since 2009, and it's amazing watching kind of the trends take place over the years. But I've always been kind of an outsider looking in, but researching the activity and kind of seeing where things progress have really been exciting over the last 12 years or so. But I think if you're talking about overall trends in Bushwick, I think it's really asset specific, right? So we're seeing really interesting things take place on the warehouse front. We're seeing interesting things take place, both positive and negative on the development front, on the retail front. But as it relates to kind of the 2A, 2B, which Adam mentioned is kind of the predominant asset type in these neighborhoods, which is, your 5 to 10 unit walk-ups. I think the first thing to note is how much it got hurt during COVID. And Bushwick being a very kind of transient oriented type tenancy, you have a lot of people that are moving to Bushwick for the first time that are trying to establish themselves in New York. And when COVID hit, they went back home, right? So I would say, Bushwick and Bed-Stuy and Ridgewoods, these neighborhoods just saw a lot of vacancy. So the last 2 years, we've been recovering from that, both on the landlord side, as Laurent can speak to, and then on the brokerage side, just trying to sell cash flow. So, I think the last 12 months, we've recovered from that. And we started to see transaction volume pick up towards the end of last year. I would look at kind of the calendar year 2021 as the case study of the current market. And I would say that is most related to 2018, right? But even since 2018, a lot's happened, right? The rent laws have changed. And, if you look at 2A, 2B transaction volume, 2018, we tracked around 60 transactions, right? But basically 6 to 10 unit buildings. And that's about the historical average for the neighborhood. You're seeing 60 of these buildings trade every year. In 2018, though, only 8 of those were above 2.5 million, right? So you're just seeing a lot of rent stabilized, lower basis type deals trade. In 2021, we saw a very similar dollar volume, right? Transaction volume. We saw about 55 transactions, but we saw 21 deals about 2.5 million, right? And out of those 21 deals, 70% were bought from a single investment fund, basically a private equity company. So there was obviously a shift coming into kind of higher end type walk-up product, right? And that's natural, and we saw that across the board. But I would say that's the biggest trend we're seeing from a 2A, 2B standpoint, is kind of this flock to predominantly renovated free market product, because people really believe that Bushwick is going to see the rent growth maybe at a higher velocity than in other markets. But Joseph, I would imagine you're seeing something very similar on your end.
I mean, the numbers speak for themselves. I mean, to your point, and I know, Adam, you started with asking about buyers and sellers as well. I mean, a lot of those developers who purchased those sub $2.5 million walk-ups did those renovations. You know, the exits we're seeing are actually in line with those developments. So they bought the unrenovated product. Either there was it was pre-2019, they could have, vacated the building and or purchased it vacant, did the renovation, either put in kind of that long-term debt post-renovation, or we're seeing that scheduled exit come to fruition now, where they're hitting their, that kind of target the life of that investment that they were planning. So it does correlate very well.
That's a strategy that was very active in 2017, 18.
Yeah, the rent laws forced. Yeah, the rent laws forced us to, basically shift from a value add market to a cash flow market, right? So the inability to turn over rent stabilized units, you transition from 1 to 3 year holds to 5 to 10 year holds or forever holds. So that was by far, when we're looking at the peak of activity, the investment strategy was, I'm going to add value, I'm going to turn it over, and I'm going to either refi or flip within 2 to 3 years.
So
right, Laurent?
When you're buying stuff, like, has it changed in the same way over the past couple of years? Or do you have your strategy and you're sticking with it and it's not going to change?
Yeah, no, absolutely. I mean, I think that, our focus is mostly on vacant buildings, right? I mean, buying a building today with, say you buy a 3-family with tenants in it, it's just not something we're willing to do today, right? The same thing with rent-regulated buildings. As DJ just mentioned, today it's more of a going-in cash flow rather than a value add, right? So you're not creating value like you used to, and so you need to pay up for or pay less for those buildings, right? You're looking for a higher return going in. But we've been focused mostly on vacant buildings, going in and kind of creating value by renovating them and eventually leasing them up in a market that is, as we were speaking, pretty strong today. So that's been our business plan, for the last 2 or 3 years, even through COVID.
Can you compete with the private equity, with like Carlyle or whoever's like buying all these things? Or are they kind of on their own and at their own level?
So, I mean, the answer is no. The private equity shops, first of all, most of them buy finished products. We mostly don't buy finished product. We buy, we look for situations in which we can come in and create value. And, if you want to eventually sell to a Carlyle or sell to one of those private equity shops, we don't buy finished product. That's not kind of what we do. We have an expertise of construction, of development, of construction management, and eventually leasing. And so that's kind of where we come in. So, to your answer is, we don't necessarily compete against the private equity shops, but, even if we would not be able to compete against them in this market.
Joseph, can you talk just about the different types of businesses? And we're sort of talking about it, but just the business plan then and the business plan now, like, how are they? I mean,
and DJ touched on this. DJ and Laurent both touched on this. So New York, for the longest time, was always a future value market versus in place. You were buying to create value. This was particularly prevalent within the tax class 2 elevator markets in the boroughs and throughout New York, where there was a schedule in which, through individual apartment improvement or major capital improvements, one can add revenue and thereby continually hit that the scheduled refinance, pull out additional funds, and it was always a value add market. So if you can buy at a decent basis, the value was there. It was just a question of having the expertise to unlock it.
Mhm.
And there was, and also these buildings were, in need of a rehab. Most of them were pre-war. So there was, the two came together, and that was the model for as long as I've been observing it. With the 2019 change to the rent regulation, the HSTPA of 2019, the value really shifted to an in place from a future value market to an in place market overnight. So most of the multi reset initially wasn't due, it was that, hit that 30% loss in value pretty much 2019 and on. At that point, the only value creation one can see was by purchasing a vacant building, or something that was sub 6 units with no rent regulation. But even so, vacating was never easy. So a vacant building is pretty much the only way to create that same value and same target return. That value and business model will always be there. It's just fewer and farther between when we come across a decently priced building at a basis that makes sense, considering you've also seen construction prices go up, volatility in the debt market. So that's a constantly moving target, but that model will always be there. And as so long as that, if there's a change in regulation, that is one of the fundamentals in real estate investing, creating that value. From a cash flow perspective, considering where debt has been in the last, for as long as I've, been an adult, rates from 2008 till 2016 were pretty much zero. 2009, I should say, were pretty much zero. Went up to 2.5%. So you had debt available at between 3 and 4.5% for even at the height. Rates were brought back down. So that then offered an ability for an investor looking at those cash flows at a levered return to hit within what is just running a baseline assumption, for example. So if you're building a 7-year hold, buying an in-place cash flow, levering it at 3.7%, so you got a 5.52% loan constant, bake in 2 years IO in there, 3% increase on the top line, 2% increases on the bottom line. Tax class 2A buildings have pretty much set taxes. You're hitting in a double digits IRR just on that purchase. So adding a little value add to the front, you're getting to that mid-teens IRR. That makes sense. You're competing with funds who are looking at unlevered, let's say the family office looking at an unlevered return. They're building to a 7-8%. They have to buy at 25 to 50 basis points above where you can buy with debt. That was your value. So you've seen a pivot from straight value add to finding some kind of way to add a little bit of value to hit that mid-teen IRR. That's what you pitch to your investors. That's what you go for. With rates rising again today, that's going to have people looking back at their models, and we're seeing hesitation based on that as to what their investment theses are. But there's, from that cash flow perspective to the value add perspective, that's really been the delta that we're seeing. That's what offered the syndicator and fund model to outbid the kind of the long-term family office and private investors. And with that, perhaps we have an even playing field going forward. Time will tell.
And DJ, like, how do you view who's in there now, who's in the game? And move on. We can also move off.
Interest rates are the hot topic right now, and I think 1031 money is keeping cap rates compressed a bit, because 1031 money is going to lag 6 months behind, I think, the traditional investor. So to Joseph's point, we were selling rent stabilized buildings at a 4 cap. 2019 happened. Now they're in line with market caps at maybe 5.5. Now they're probably 50 basis points higher than market cap rates, right? So that was the big shift. Now it's interest rates. So we were focused on cash. And the reality is if interest rates go up and we're so cash on cash centric, you need to see net returns increase by 15 to 25%, depending on where interest rates go. So that's what we're tracking. And that's what we're trying to understand is, can the market absorb these rents? And I think we can. I don't think there's any new product being developed. I think we've got a supply issue here in New York. Rents are up 30% in Williamsburg. They're up 20% in Bushwick. I don't see that trend going anywhere because there's no new product. So the question, Laurent's point before we jumped on was, can we see rental growth and appreciation enough to offset these interest rate hikes? Because inflation comes appreciation, and how quickly are we going to be able to see that appreciation? So Laurent, I mean, you could probably speak to that just in your own rent growth within your portfolio. Like, what are your predictions for the coming year?
So yeah, I think that just to touch upon what you just mentioned, it's imperative that rent growth keeps in track with interest rate growth, right? I mean, I think we've all been kind of astonished with how fast the rates have gone up, what we see in Bushwick and Ridgewood right now is, I'd say in line with what you just said. I think, we're probably 25%. There's probably a 25% average increase in rental growth year over year. But, take into consideration that the base rents were discounted, off the start. So, we're probably 15% over 2019. And it depends where the rates end up being. If we go towards a 6.5%, environment, it's going to become a problem, right? And so, it's going to be a wait and see approach, and there's going to be buying opportunities. But it depends where we go.
A question on the tenants. Are you seeing different groups of people who can pay? I mean, to have your rent go up by 20% or something in a year, or 20% from the last time you signed a lease, what ends up happening most of the time?
And just Adam, as a reference, like a 200 basis point increase in interest rates. So from going from 3.5 to 5.5, to offset that, to still collect your 8% cash on cash. In an area like Bushwick, you need to go from $2,800 a month. Let's say that's a 2-bedroom apartment, to $3,500 a month. Okay, so like that's the comparison that we're making. Is can rents jump from $2,800 to $3,500? In Williamsburg, Williamsburg didn't get hurt as much as Bushwick did during the pandemic, right? So they're kind of a couple innings ahead of us, and their rents are still going up. They're still 30% up. And Bushwick has always been the receiver of tenants from Williamsburg that can no longer afford to be there. So as long as Williamsburg continues to outpace us, I feel good that tenants are going to keep flocking to Bushwick because retail is back, the nightlife is back, the transportation is there, the product is there. So, like the question is, and Laurent's going to be, is going to be able to answer this before anybody else, is can we get from 2,800 to 35?
I mean, if I could just add one point to that, we're talking about a transient-centric market, like DJ said. So for, say, a 3-bedroom, 2-bathroom apartment, right? So during COVID, there was a rent reset where those apartments which were renting between $3,300 and $3,500 pre-COVID went to $2,750 to $2,800, and that was mostly due to what was a roommate-driven market where you have 3 roommates come split the rent at say $1,000 to $1,100 per room. They were no longer there. They went home to their parents. There were rent concessions offered just to keep these buildings occupied at sometimes a 15 to 25% discount in those rents. We are already seeing the pre-COVID rents having come back even before the summer lease-up season. So from that $2,750 to the $3,000 to $3,200 rent. Right now in the summer, we're already seeing those 3-bed, 2-baths renting for $3,500. So you have that 30% increase in rent just right there in a relatively short period. Now, where it goes from here, that's a question for, I think supply and demand, but those are the fundamentals which we're dealing with. And from a roommate perspective, at $1,100 per room, $3,500 is only $1,150 per room. So that is still a relatively affordable rent for those for the tenants, which the avatar tenant that these units were kind of created for.
And Laurent, are you seeing these are essentially people moving east, or where are you getting your renters from?
So it's actually interesting just to touch back on your previous question where you asked me what happens with the current tenants. So it's a tricky situation because most of those tenants got, call it a discounted or heavily discounted rent a year ago, right? Or 2 years ago, while, during COVID. And so when you're in a position right now where you have to increase it, right? Your taxes go up, your insurance go up, everything goes up, right? And so, and it's not an easy situation. It's like we have to increase it. And so Basically, what we've seen is we're leasing it to new tenants who come in, and on a price per bedroom, they still find it to be pretty attractive in terms of pricing. So they see good value in paying, say, $1,500 per bedroom for a 3-bedroom duplex with a garden, right? And so we've seen new tenants come in, replacing old tenants, and paying up, and paying up per bedroom, and paying up. So I believe it's going to keep on going during the summer and maybe after.
Yeah, and summer in Bushwick is amazing. I mean, just go down to Jefferson L train and just hang out there for an afternoon. I mean, there's music venues opening up all over the place. There's retail is back. Like last summer was like, it was starting to come back. This year, it's totally back. I mean, the streets are packed. I see kids on like Instagram at these music venues that I used to babysit. I mean, there's a lot happening over there that's drawing people to Bushwick.
But one last question on the why isn't there more sales right now? If prices are going up, and even with the sort of like slight scariness of whether interest rates are going to sort of knock you out, it looks like sales are sort of on track to be, a good year, but not a year where there's 20% rent growth.
So I just want to touch on that. I think that it's a good point. I think the problem is there's still a disconnect between buyers and sellers. When you have a mom and pop owner who owns a 3-family building and wants to sell it, right? Well, the buyer that's buying it usually doesn't want to buy it, with the tenants in place. They want it vacant, right? And it's not easy to vacate a building. And most owners don't want to vacate the building, right? Same thing you're seeing with the rent-regulated buildings, whereas in 2015, 16, 17, 18, you got those crazy numbers. Well, guess what? We have a new reality, right? And sellers are having a hard time adjusting to that reality. We're getting there. And I think that's why you still see that disconnecting between buyers and sellers. And that's why you don't see as many trades as you'd want to see.
I would add to that. I mean, you're always going to have the scheduled sales of properties. The proverbial 4 Ds in real estate. There's the death, divorce, divestment, and debt, which typically drive a sale. But again, it's also about looking at the profile of the sellers and buyers. So looking at the long-term seller was always a focal point for the value-add investor seeing an opportunity there. A lot of times they're not as in tune with what is going on, say, with rising interest rates, as there's at times little to no debt on these properties. They've kind of owned it forever, and they've been, hit up for the last 10 years constantly, and their idea of value versus what the actual value is isn't always there. So it's kind of a mixed bag with a long-term owner. Obviously, if there's a scheduled sale, that will always transact. But if they sell to market, but there is going to be a disconnect. And as far as the professional investor, it really depends on what they're dealing with. I mean, if there's depending on the basis, depending on the different, if they dealt with a curveball in their business model, sometimes debt refinancing became an option versus a sale that was going to be scheduled. So it really depends on the reason behind why a seller is selling, and not always does it align with what any given buyer will be looking for at any given market. So, a lot of things do have to come together, but yeah, there will always be a 1031 buyer and a scheduled sale, and those continue to happen, which is the broker's bread and butter. Yeah. And then it's a question of connecting some of the other. There's always
a lag when there's a big shift, right? And interest rates were a big shift, and rents aren't going to catch up as quickly as, it could take 12 to 18 months before rents catch up. So there's going to be a stall, which is what we're experiencing right now. And like I've only tracked 13 transactions this year so far out of the 55 that we typically see. Now, like that's probably through April. So, but it certainly seems slower. But like if you look at New York City averages and we tend to see about 3,000 trades a year, and we've only seen about 1,500 for the last 2 years. So we've got 3,000 properties that wanted to sell in the last 2 years and just haven't. So like there's going to be a little bit of a floodgate there, and it's not necessarily going to be fun because a lot of people are going to sell because loans are coming due and life decisions need to happen. But transaction volume is going to pick up, and so there's opportunity in that.
And to pivot a little bit to some of the other asset classes. So like what's going on with, you started talking about entertainment and there's other like production facilities. What's that market like?
Yeah, in like 2015, well, one, I was selling warehouses in on the Jefferson L train for $100 a foot in 2010. And we were selling development sites for $45 a buildable. And then like, 3 years later, $250 a buildable. And we're selling warehouses now for $800 a foot on, basically it's retail pieces, but there's been some big music venues that have invested a lot of capital and their whole business model around being a dominant force in that Bushwick market. So I think the music scene and the art scene surrounding the Bushwick Collective is going to continue to mature. And I don't think COVID put that to death. I think it's going to continue to thrive, which was great to see. And then, for the bigger sites, particularly on the industrial front, you see a lot of end users buying the stuff below 10 million. And then you see a lot of, so that could be, somebody that runs a business that wants to do retail/industrial kind of manufacturing with retail combination. You see a lot of people with access to that type of capital buying the smaller stuff. And then the larger stuff is going to logistics centers, the bigger industrial warehouse operators, and then studio spaces. So like Netflix moving into East Williamsburg was huge for the economy in this particular pocket. It was good for the hotels and for the retail. It brought an economy to this area that was supposed to go in the direction of office, but office didn't take off, and studio space came in and saved it. And I think there's a lot of businesses that are starting to populate around that area that are tailoring towards studio space. That's something I keep an eye on for the next cycle.
And there was also, we were talking before that there was a change in the tax law for the storage companies that removed a benefit for them. So what's the impact, and is someone else taking those spaces?
So a lot of the bigger commercial spaces were being sold to storage facilities because they could benefit from below grade FAR and multi-story FAR, where the only other options are really community facility, medical, or hotel, which you can't really do anymore. So the storage guys were the predominant buyers for that stuff. And then during the pandemic, when they were patching the budget laws, they slid it in there that the storage operators can no longer benefit from an ICAP abatement, which is basically a affordable New York abatement for commercial spaces. So that basically eliminated that entire market because they couldn't, their prices dropped 30% because now they're getting taxed zero to getting taxed 30% of their income, and just it really hurt that particular submarket. So a lot of people that had bigger commercial pieces of land. We had one in particular that was on the market for 10 million and ultimately traded for 6.5 because the storage guys just couldn't compete anymore without the abatement. We're talking about huge discounts.
Even though there's still people who need all that storage space, all the companies or individuals.
Yeah, the reason the storage companies were buying all this space is because there was an enormous demand for it. And it's not, people are against storage facilities because they think it doesn't provide jobs and it's an eyesore in their neighborhood. But the reality is they support a lot of small businesses that can't afford their retail spaces. So, a lot of these storage guys, 50% of their tenants were small businesses that were just using it to store their equipment and stuff like that. So like it was providing a service that we no longer can provide.
And is there any office? Ridgewood has one of these, the box, and they have. Is that the box? Are there other people doing stuff like that?
Yeah, the box is a great facility. You should check it out. Like they did a really good job with that. It's boutique, so like they've got creative kind of experiential office, so sound studios and stuff like that. It's not your traditional Class A office. So office has been really tough to justify because you need rents to be above $45 a foot. And there's just been a couple of case studies where, Savannah did a phenomenal renovation on Evergreen and they ended up leasing it to the city, but they were hoping to attract some big tech companies. And there's just too much office product available in Brooklyn right now for these tertiary markets to benefit. So I think maybe office is another chapter of Bushwick, but I don't see that really taking off over the next 5 years.
So, well, going to end it there, and I want to thank you all for participating. And this is going to be on our YouTube channel probably in a day or two, and so we can find it there. And thanks for watching, and have a good afternoon.
Thank you.
Thanks, Adam.
Take care.
Thanks, everybody.
Take care, DJ.